This podcast is brought to you by Customplan Financial Advisors, Inc., an independent insurance managing general agency in Canada. Financialpodcast.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello and welcome to the Financial Podcast. My name is Gary Poyer. The Financial Podcast is brought to you by Customplan Financial Advisors, an award-winning managing general agency that provides exceptional support and resources to the independent financial advisor. Please visit customplanfinancial.com to see all the resources that are available to you as the independent financial advisor. Today we'll be focusing our discussion on a topic that's very important to a lot of Canadians, that being charitable giving. And to help us to understand this topic, we have with us today Michelle Coleman of MNP in Edmonton. Michelle, welcome to our podcast.
Thank you.
Actually, Michelle, I should say welcome back, because you were our guest back in July when we talked about death and taxes. So I appreciate you coming back on to our podcast.
Thank you. So it's great. It's great to be here. I appreciate the invitation.
Well, it's great to have you. Michelle, why don't you refresh our memory about your background and about MNP?
Absolutely. So as you mentioned, I work out of our Edmonton office. And so MNP is a national firm and able to provide support to clients across the country. And within our organization, we have a number of individuals who specialize. And I've chosen to specialize in trust and estate planning, which intersects very nicely with charitable giving, because we're helping clients realize the legacy they want to realize in as tax efficient a manner as possible.
Right. And that just goes to show you how broad tax planning is and estate planning and how they're connected. I think a lot of Canadians are familiar with registered charity because they're fairly common, but where else can a taxpayer make a donation and experience the benefits both on a personal basis and on a tax basis?
That's a great question, because so many of us automatically think of registered charities as being the only place that we can give our support, which are certainly very deserving and do lots of great work. But there's other opportunities as well for things that are very near and dear to your heart. So you could consider National Art Services organizations, Canadian Amateur Athletics, housing corporations that provide support for low-cost housing for the elderly, municipalities as well, if you want to donate at a very local level for things that your local community is doing. Universities outside of Canada who have Canadian students. So if your alma mater is outside of the country, you can donate there. United Nations and political parties if you want to make your voice known that way. One thing that people don't always think about is if you do have U.S. income, you could make donations to U.S. charities like public television or universities or other organizations. You're limited against that U.S. income, but those donations wouldn't be lost. But if you're ever not sure when you're advising a client or looking at things for yourself, you can access the Charities Directorate to ask them for advice. And Revenue Canada has a wonderful list online that you can click through of the registered charities and confirm that they're registered and what their status is and whether or not they're active.
Yeah, I find it interesting that a person can make a donation from all the way up to the UN and down to the local level.
Exactly.
Yeah. Have you ever had anybody donate money to the UN?
I haven't, no, because I've had clients who have wanted to donate to international organizations, but they've been able to step back and find the Canadian branch of that, like Doctors Without Borders or an organization similar to that, that has organizations throughout the country that look after international events, but not the United Nations. So now I'm curious.
Yeah, me too. Michelle, can you explain how the charitable non-refundable tax credit works, and maybe a little bit about the tax credit?
Sure. So the charitable donation credit, like a lot of other credits, is non-refundable. And so by that, it means that it can be used to reduce taxes owed, But if you don't have an additional amount of tax owing, you can't get a refund additional from that. But that's not to say that they're not a very useful credit, because excuse me, they are a credit that is actually a higher credit than many others. So in order to determine that credit, you'd first look at the eligible portion of your donation, because it might not be the full amount that you paid. For example, if you went to a gala dinner or donated to public television and got a book back or something, your donation may not be for the full amount. So for example, if you went to a fundraising dinner, you might pay $150 for your ticket, but when you get your donation receipt, it may have taken a portion off to pay for your dinner. So you get a donation receipt, perhaps for $100 or some other amount that's considered to be eligible. So you want to look at that line on your receipt of what the eligible portion is, as that will be clearly denoted on your donation receipt. And in any year, you can claim the donations you've made up to December 31st of that year. If you have unclaimed donations from the previous 5 years, you can use those as well. And similarly, if your spouse or common law partner has made donations that they haven't used in the last 5 years, those can be used as well. And so as far as I was commenting earlier, that credit's a very effective credit, and sometimes that lumping together for spouses works well. So if we look at the federal level of the credit, it's 15% on the first $200 of donations and 29% on additional donations. So you also may want to bunch some of your donations together and pull them ahead to a year when you may have additional income, so that you get that 29% credit. Under certain rules, if you're in a high income bracket, your credit will be 33% federally. And also the provinces have credits as well that range sort of from 4% and up. In Alberta, that additional credit is another 10%.
Okay. Wow. Sounds complicated, although
your sort of guideline is to think of it as it's about 50 cents on the dollar.
Yeah.
When you're looking at what that will overall be.
Okay. Well, that sounds good. Well, yeah, I say it's complicated, but that's why there's people like yourself in the accounting industry to help us understand it. What are the restrictions when it comes to the dollar amount that a taxpayer can contribute to a charity in any 1 year?
So there's no limit on what you can contribute other than your own budget, but you are limited in what you're able to claim. So that's why I was commenting earlier. Sometimes you have amounts that you would carry forward. The amount that you're able to claim for credit is limited to 75% of your net income. And so you can't eliminate all of your taxes with donations, with the exception of in the year that you pass away, you are able to increase that credit to 100% of net income in that year.
Okay. Unfortunately, you have to pass away.
It's a bit of a difficult option, but it is a consideration for individuals who maybe want to do some overall planning, particularly if perhaps you've received a rather shocking health diagnosis. You may want to look at how you might want to deal with things. It's not an easy choice, but it is something people may want to consider and see some of the benefits of that before they pass away.
Yeah, exactly. So if a taxpayer makes a donation in any 1 year that exceeds his or her net income, or the net income limit for that year, what options are available to the taxpayer?
So they can transfer those credits to a spouse or common law partner. So if that individual has room to use that credit, that's certainly able to be done. Or as I mentioned earlier, it can be carried forward up to 5 years. So you do have a good window in order to be able to use those credits.
Okay, well, that's good. It's good to know that you have some options if you over contribute. So what are the rules when it comes to claiming charitable donations with regard to spouses? I think you touched on it a little bit earlier, but can the donations all be used by one spouse? And is that in the tax act itself?
It's not in the tax act itself. It references the ability to be able to make that claim. But administratively, and in the notes to the Tax Act, Revenue Canada does allow one spouse or common law partner or the other to claim all of the donation receipts, or it can be split between the two to be best benefit. But because we have that first amount that's $200 that you're getting that lower credit on, we quite often will put them all on one return or the other, unless there's some other tax reason not to.
Yeah. There's no danger that the CRA would come back and say, that's not actually the law. You can't do that.
We haven't had that happen. I mean, it would be quite punitive to impact a household that is donating, just because the receipt came back in one name. But if there was anybody who did feel uncomfortable with that particular risk, they could ask the charity to make the donation out in both of their names, their receipt.
Yeah. Yeah. I don't imagine the CRA would ever do that. I mean, it would be so unpopular.
It would, and would be unfair.
Yeah.
Now, the one area that we feel is maybe a little riskier is if we have donations that were made in the will of an individual. And so when that individual passes away, it's a little riskier to say that those donations belong to the spouse, because they don't. They actually belong to that individual and their estate, which is a separate entity for tax purposes. So those ones were it's a little less clear on whether or not a spouse could claim. But when both individuals are alive and making decisions together, we haven't had a problem putting them together.
Okay, well, that's good. It's good to know. Now, earlier you kind of listed where a person can make a donation, but does it matter whether a taxpayer donates capital property to a public charity or a private foundation?
So there's a number of different ways you can donate, and all of which bring great benefit to the organization and to the donor themselves also, both that satisfaction that you mentioned earlier and tax benefits. So public charity donation is a simple way to impact your community, like going to a registered charity. Excuse me. A donation of assets, whether that's cash or securities or in-kind donations, can be given directly to that charity of choice within the taxation year, and you'll get a donation receipt. The easy thing about that is you can pivot very quickly on what you would like to support. And if you hear of a particular initiative or project that you want to be part of, you can very easily switch your donation plans for yourself.
Right.
A private foundation, excuse me, allows you to manage an ongoing legacy for your family and have your family involved in that overall board of doing that. And donation planning can also be done to offset a significant taxable event. So, for example, if we had a taxpayer who sold their business and we knew there was a significant taxable event, they may want to consider, if overall donating is part of their legacy planning, setting up a private foundation and doing a significant donation to seed that private foundation that the foundation could then transfer out to charities over time based on the rules for charities. And so that allows a lot more flexibility. It does require a bit more administration, though, and it does have to file its own tax return, but it does allow you to control that distribution over time. Like, I have a client who they've set up a private foundation, and it's a way to have their children very involved in building this overall family legacy. And every year between Christmas and New Year, everyone has to present where they want some of their money to go. So if you're 5, you just have to say you like animals and you're good to go. I mean, that's your whole report. But if you're a teenager who is somebody who's going to be becoming part of that overall decision-making process and legacy as adults, you're responsible for looking into the charity. Where do they spend their money? What do they support? And so it's a great way to teach people how to be valuable stewards of that family legacy. But there's other options too. Many communities have a community foundation. Edmonton, for example, does, and several other communities do, which allows you for that level of control without that administration. You can set up an endowment that pays over time, that they then administer, and you don't have the tax filing requirements for. And many financial institutions also have a very similar foundation type product, for lack of a better way to put it, where similarly you can make significant donations and work with your financial advisor over time to distribute those funds, or also sort of allow those funds to grow for scholarships or whatever you wanted them to be. So there are a lot of options, just depends on how involved you want to be in the administration of things. But there's so many great options that people can use.
Yeah, sounds like it. I was going to ask you how hard it was to set up a private foundation, and is there a dollar minimum that is required in order to set one up?
So for a private foundation, there's a bit of work to be done because it has to be set up as a corporation and then also needs to register with Revenue Canada as a charity. Right. So there's some hoops to go through where you're giving quite reasonably, being asked who your board of directors are, what your planning is going to be, what sort of things do you expect your foundation to support. So it does take some time. So you can't decide December 1st, oh, I'd like to have a foundation and be able to donate by December 31st, because red tape grinds slowly sometimes.
Yeah.
But once you have it set up, you're treating it like a corporation and needing to have board meetings and have a board set up and advisors and ongoing tax filings. So there is that to consider. As far as a baseline, sort of need to balance it with the cost of setting it up and the costs of preparing those returns or having someone prepare those returns. But often when we're looking at talking to people, we're looking at maybe seeding for $100,000 or $150,000, and then thinking of $20,000 to $25,000 of donations each year consistently as well. But there's certainly no upper limit, but the lower limit, it has to be sort of offset with the cost of administration.
Okay, well, makes total sense. Unfortunately, it eliminates me from setting up foundation as well, but that's another story.
That's why there's community foundations and financial institutions who have a very similar type program.
Yeah, exactly. Okay, well, charitable donations can be classified in various ways, such as charitable gifts, crown gifts, cultural gifts, and ecological gifts. What in the world is the difference between all of these gifts? And can you maybe elaborate on those, please?
Sure. So some of them are sort of descriptive in their names, but they have some different tax advantages or limitations. So charitable gifts, pretty straightforward. You donate whatever you're going to donate to a charity, you get your receipt, and you're good to go. So that would be, items that you donate to silent auctions, cash that you give to charities, time that you give to charities that may be eligible. Crown gifts are eligible amounts of gifts that are given to the government of Canada, a province, territory, or municipality. So we're looking at government, essentially, at whatever level that is. It doesn't include donations to political parties, but the governments and the municipality on up. Cultural gifts are a little more interesting. I don't know how many of us have a cultural gift hanging around in our attic that would be appropriate, but who knows? There's additional incentives because it's meant to retain Canadian cultural property within Canada. So items that have outstanding significance. So artwork, for example, or historical books or maps or things that would be very much a part of what Canada is and where it came from.
Okay.
So you can donate things to Canadian institutions, public authorities. They have to be designated as such at the time that you give the gift. After 2019, the gift no longer needs to be of national importance, so it can be of importance to the level of government or organization that you're contributing it to. It's based on the eligible amount of the gift based on the fair market value that the Canadian Cultural Property Export Review Board, that's a mouthful, says that it's deemed to be. But that claim for credit is not limited to a percentage of net income. And so you could, in theory, offset 100% of your income with a significant cultural gift.
Okay.
You don't realize a capital gain on that, so there's a tax advantage from that perspective also. And you can deduct capital losses with some limitations. But in the same way that CRA does watch out for some of those weird art scams and things, if someone offers you artwork for $100 that's significant that you can get a donation receipt for $1,000, same rule applies here. If it sounds too good to be true, it is too good to be true. Ecologically sensitive land is to protect grasslands, wetlands, various things like that for Canada and the use of future Canadians as well, so that we're not losing those things that are so valuable and makes Canada so special. So it's a tax credit as well that's based on the eligible amount of the gift. It could include a covenant or an easement. There's some special rules in Quebec, so if we have people in Quebec, we can look those up if somebody wants to. They can't be made to a private foundation, though, so that is a limitation on land. The Minister of Environment and Climate Change, or someone that the Minister of Finance designates, has to certify that the land is eligible, and they will also determine what amount will be allowed for that donation. That property has to be protected and not used for anything else. So you do need to keep in mind that you're giving this and you're now not going to farm it, develop it, do any of those things. It's meant to be protected. And again, that claim's not limited to income and can carry forward up to 10 years rather than 5. Now, if that donation's made after February 11th, 2014, but since we're dealing with current donations, that shouldn't be an issue.
Yeah. So it sounds like if a person wants to make that kind of a donation before December 31st, it's probably not going to happen, right? With all
probably
the
not, no. So those are ones you'll need to plan for a little more, because they need to be, the last two, cultural and ecological, need to be approved by government agencies. So it's best to start that planning process a little earlier.
Yeah, for sure. This is a bit of a long question, so I'm going to read it here. But when a taxpayer disposes of capital property by gift or bequest to any other person other than the spouse or common law partner, there's usually a deemed disposition, and there could be some tax liabilities. But when a taxpayer donates capital property to a registered charity, does this deemed disposition still apply? Or does the Income Tax Act make any allowances?
So for regular capital property, so land or depreciable property like buildings, for example, so if it would result in a capital gain or loss, you do still have that deemed disposition, the same as you would if you disposed of it any other way.
Okay.
It doesn't include inventory of your business, or if you were a land developer, for example, it wouldn't include your land because it was included in inventory.
Okay.
But there are, those other examples of real estate, securities, that type of thing. But if you donate that capital property, as I mentioned, you're deemed to have disposed of that for proceeds equal to fair market value, as you noted in your question. You have to report that capital gain on your income tax return in the year you donated the property, but you also might be able to claim a capital loss, so you can consider that in your overall planning, perhaps.
Okay.
But there are some limitations on what you can claim. So if you make that donation, if the fair market value could be determined as an amount that's designated. It can't be greater than fair market value and not less than the greater of the advantage that the gift is worth, or the adjusted cost base of the property. So if the property is depreciable property, it would be the lesser of the adjusted cost base or the undepreciated capital cost, or the UCC of the property. So typically, we see people looking at those differences between fair market value and adjusted cost base and being able to claim an appropriate amount in between. So the amount that you choose for the proceeds of disposition is the amount that you would use to determine the eligible amount of your donation as well. So you also may have to have some interconnections with the charities that's receiving it, because they also may need to appraise it and say, this is what we're willing to give for a donation receipt. So there will be some back and forth between the charity. When you're donating, those things are a little more difficult to value.
Right. This is a kind of a question that's more from the charitable organization perspective, but does a charity or a foundation have to approve of a donation? Like, can they reject a person's donation if it doesn't really fit their criteria?
They can. So a charity can choose to not accept something if overall the administration or cost to determine value or some other, or it doesn't fit their values. They can choose to not take the donation itself. Which is why when we're dealing with estates, one of the first things that your lawyer will start to do if there's donations in your will is actually get an approval letter out to the charity saying that they will accept their gift when the value is determined.
Yeah.
So it's interesting and it's fair because if you saddle a charity with real estate, for example, and they have no way of dealing with it easily, you've perhaps created more expense than the value that they're getting. Real estate might not be a great example because real estate is usually quite valuable, but in general, if you've got things you have to now figure out what to do with, it just may be more difficult.
Yeah. I know when it comes to estate planning and the creation of a will, they always say, or lawyers will tell their clients, make sure you have the name of the charity correct, because you don't want you don't want any question as to which charity you're talking about. But I personally
you want it to be correct and precise.
Yeah. Well, but I've never thought about getting an approval letter from the charity. I just think they'll accept anything, but that's not true.
No, and back to your point on having that name correct. When I was dealing with my mother's estate, and it allowed for a donation to the Parkinson's Society of Nova Scotia. Well, there isn't a Parkinson's Society of Nova Scotia. There's a Parkinson's Society of the Maritimes or Atlantic Canada. I can't remember which. So there was just a little extra hoop to go through. Now that one wasn't too bad because we could narrow down to what she meant and who she was getting support from. But what if you have an organization that could be several things? Like, do you want to just say Rotary Club? Do you want to say the Rotary Club that I attend, whatever that may be, whatever your chapter is, the Rotary Club of Canada, Rotary International? So it's important to be precise in what you intend, or your estate ends up with expense of trying to verify who that is.
Yeah, absolutely. So that's why, a person probably should never do their own will.
No, they should make some good notes, and if they buy one of those will kits, it's good to get the questions you'd go through with the lawyer, but absolutely deal with a good estate lawyer who can talk to you about what your options are and what makes sense.
Yeah, absolutely. Okay, we've talked a lot about making donations, but what are the methods by which a taxpayer can actually make a charitable donation?
So assuming the charity is comfortable taking with whatever you're planning to give, you can make the donations directly to the charity of either the capital assets, securities, cash, or you can do an in-kind gift perhaps. Perhaps your business would like to support a festival that's happening in your organization and say, well, we're willing to do a particular type of craft beer that's labeled with your festival, and this is what we would like to donate. And so there are options of doing in-kind support of organizations or activities as well. People can liquidate assets to donate cash, or consider the donation of things like insurance policies and things as well. So the donations would be made directly to the charity, or if we're looking at those foundation options, donated to the foundation, endowment fund, or organization through your financial institution, and then you would give direction on flowing it through to the charities of your choice.
Okay.
Or charities, or that list from the beginning as well. So you do have those other options too.
Okay, excellent. So when it comes to when a person should actually make a donation, there's a couple of options there too. For instance, what are some of the benefits of it for a taxpayer to make a donation prior to death? So when they're living.
Mm-hmm. Well, as we mentioned before, we do have that carry forward. So sometimes people will specifically make donation or planning for donations leading up to a rather imminent passing, because they want to be able to see the benefits of what's happening. So it really comes down to, can we use it in tax returns now or not? But as excited as I get about tax, the donations mean so much more to your community and to yourself and what your family and what you want to do. So that big benefit really is being able to see what good your donations can do, and have the charity have the opportunity to thank you for or the organizations to thank you for those items as well. For example, I have a client who we're working through his retirement planning, sort of in advance of estate planning, where he's taking extra money out of his RIF each year because he says he can't spend it all in his lifetime. So he's taking a little bit extra out each year and offsetting it with a donation to his local library, which was an area or an organization that his wife was particularly used a lot and enjoyed the library and the services it provides. And so now he's able to actually go, the library knows they're getting a specific amount each year over the next 5 years. That's the plan we have. They can now plan for what they want to do. And he's also able to go and enjoy just sort of a memory of his wife and seeing the plaque there on the wall and seeing the events that be able to put on because he's made that donation. That donation would be very valuable in his will as well, but he wouldn't get to see the benefit of it. And that's really not measurable.
Yeah, exactly. But it's that personal gratification, right? That you did something and you benefited people, and you can actually experience that. Now, a lot of people wait until they do pass away and they make a charitable bequest. So what are some of the advantages for a taxpayer when they wait and do it through their will?
So you can make those donations in your will. They should be specified, as we noted earlier. And your will should also be written in such a way that allows your executor opportunity to do tax planning in those donations as well. So whether they donate capital property versus liquidating and so on. So having that advantage, because maybe we can offset some capital gains if we're donating actual assets. Donations in the will, though, give us a lot of flexibility on where we're going to use those, as we can use them on the individual's terminal tax return up to 100% of their income. So that's their final personal return.
Right. Yeah.
We can carry them back to the year before they passed away as well, if there's tax that can be recovered from that year. Or we can use them in the graduated rate estate returns as well for up to 60 months. And so we have a lot of opportunity where we can use those. But in order to be able to use those, it's very important that your estate is a graduated rate estate. So you need to make sure your advisors know to reach, or your executor rather, knows to reach out to advisors soon in the process to make sure they don't taint that status. We could do a whole hour on that by itself, but just ask for advice before you make any decisions. But it does allow you to look at where those donations can be used over essentially a 7-year spread of time of where they can be best used.
Wow. Complicated. To me, it sounds complicated. To you, it's probably, a piece of cake. But so I'm going to throw another term out here. Charitable remainder trust. How does a charitable remainder trust work, and what are the benefits to the taxpayer?
Excuse me, a charitable remainder trust allows for that overall planned giving as well. So you donate or transfer a property into a trust. You as the donor retain a life interest in the property. So for example, maybe a vacation property, or maybe your home is close to the university and they want to expand or something. You have to make an irrevocable gift of the residual interest in that property to the registered charity. And then a donation receipt would be issued by the registered charity for the fair market value of what they think the residual value of the property would be. And so that date is determined of when that property would vest in the charity. So there's some calculations to do to see what you get for a donation receipt. There's some limitations in what you have to do. You have to give the property voluntarily without any sort of expectation of what you're going to be giving back. So it has to truly be a gift. Okay. It has to vest in the organization. So once you've given it, you can't take it back. The persons who are entitled to the gifts of the charity has to be in existence and still in existence later. So you want to pick a charity that's pretty well established. Right. The size of the interest is ascertained, so it can be measurable. no conditions attached, with some pretty specific limitations. And again, I mentioned you can't revoke it. And it has to be really clear in the trust document that that recipient organization is going to get full ownership and possession of that property once the conditions are met. So essentially, once the individual passes away, or conditions of the trust are met to transfer it.
Okay.
So it lets you give something away, still use it, but get a donation receipt right away.
Okay. Well, so again, it's planning while you're still alive.
Exactly. Mm-hmm.
Okay. What about a residual trust? How does a residual trust work, and what are the benefits to a taxpayer?
So it's very similar to a charitable remainder trust, because you're donating that future interest, but still retaining your life interest in that property. You maintain control during your lifetime, but it allows for planning for probate, for example. And in Alberta, we don't have significant probate fees because it's a set court cost, but in provinces like British Columbia, Ontario, Nova Scotia that have high probate costs, moving things into a trust does allow for the property to be outside of your name. So we're good to be able to plan for probate there. Provides you just overall peace of mind that planning's in place, but it's also private because it's not a matter of public record. Your will is a matter of public record, whereas trusts that are set up are not. So it does allow you to perhaps be more circumspect about what your donations are, and I guess what your wealth is as well. And you get an immediate tax credit, similar to above, as long as you meet the criteria.
Yeah. Hey, you mentioned about will being a public document. I often wonder how many people actually go down and read other people's wills.
I really have no idea, and I've wondered that myself because personally, I've never gone to read someone else's will. Yeah. But when I've had to search a family member's will, because we needed to be able to determine an estate issue. I mean, it was relatively easy to get. You paid a fee to the court, and you got a copy of the document.
Yeah.
So it's not difficult, and sometimes necessary in order to be able to do that next layer of planning if you can't quite tell what was filed for the previous estate.
Yeah, yeah. And it's just the number of people that don't have up-to-date wills. Hopefully, those aren't the people that are going down and reading other people's wills.
Getting some ideas,
yeah. So they're retired; they have nothing else to do, so they read. I don't know.
Well, some people check the obituaries out as well, so I guess it's along that same line.
Yeah, well, I check them out, but I'm at that age where my parents' friends are passing away, or people I grew up are passing away too. So, you mentioned about life insurance once or twice throughout our podcast. So, how can a term life insurance policy be used for charitable purposes? What are the tax benefits to the taxpayer, and maybe touch on whole life insurance as well?
Sure. One of the first things we mention to clients when they come to us and say, well, I think I'm going to cancel that policy. I don't need it anymore. Perhaps I had it in place because I had a mortgage on a property and now that's paid off, and I don't need that any longer. Or, the premiums are maybe higher than I think I need in order to offset my estate tax. I'm sort of balanced out now. I've reached a point. So we always ask clients to check for a term policy. First, we always ask them to check whether or not there's a conversion option, because maybe we can flip it into a more permanent insurance. But also before they cancel it, we say, well, you've put money into it over a significant period of time. And so before you cancel it, is there something else we can do with it? And maybe canceling it will still be the right decision. But life insurance policies are a very useful donation tool as well. So there's a few options, and for either term or whole life, you could take out a new policy that's in the name of the charitable organization, and you'll get a donation receipt for the cash value of the policy. And as you're paying premiums in the future, you're getting a donation receipt each year as well. And that might be a way that you can give a very significant donation in time to someone. For example, I have a family who who mentioned to me that they want to significantly donate to the Children's Hospital because one of their children was ill when they were born, but with a young family and just starting out, they can't give the amount that they would like to. But because they're young and healthy, their insurance is not prohibitively expensive. So they have purchased a policy and they get a donation receipt for the amount each year. And eventually, hopefully a long way away, but eventually there will be also that significant donation that they'd like to make. So it can be a very valuable planning tool for you to give back in a very significant way by sort of making payments each year. You can also name the charity as a beneficiary of an existing policy. At the time of death, the charity is going to receive that policy, and the estate will receive a tax receipt. So we're able to offset taxes in the estate. The taxpayer continues to own that policy during that time. So you don't get a donation for the premiums you've paid in that instance. Your estate will get a donation for the final policy. But it can overall help with probate fees and planning as well. So we're looking at who's going to have that policy. If the estate is named the recipient of a policy, it's included in your estate. So if you're overall looking at donating, it's a good option of maybe naming that charity as the beneficiary instead of your estate to move it outside of your estate and not be listed in probate. You can also transfer ownership of an existing policy. You get a donation receipt for the cash value of that policy. If you continue to make the premiums, you'll get donations each year. But you do need to be careful that if you're transferring a policy that already exists, you actually have a deemed disposition of your insurance policy, and that can be significant. So before you make that jump, check with your insurance advisor on what the value currently is, and also check with your accountant to make sure that you realize that that's an income inclusion of perhaps a couple of $100,000 or something, and are you able to plan for that? So you just want to make sure the benefit outweighs the cost. Don't just automatically donate it. Do a little bit of research and see if it makes sense. But it can be a very valuable tool.
Okay. Well, your answer kind of brought two questions to mind. First of all, so earlier we were talking about capital property and the deemed disposition, that if you donated the property, there wouldn't be a deemed disposition. But that's different with insurance?
Oh, with capital property, there is still a deemed disposition.
Oh, okay.
Or it's an actual disposition.
Okay.
Because you've given it away.
Okay.
And similarly with your insurance policy, if you give it away, there is a disposition, but it's not a capital property. So it's a full income inclusion rather than half.
Oh, interesting. Okay. And earlier we were talking that if you name a charity in your will, it's important that you get their approval. If you name a charity on a life insurance, like the beneficiary, do you still need to get the approval, or? I haven't had
any clients have issues with insurance policies. I mean, ultimately, it's a donation of cash from the recipient's perspective. So it's not. Yeah. There's a bit of administration, perhaps. Now, in instances where you were donating the policy in such a manner that the charity would actually be continuing to pay the premiums, that would be something you should discuss with that charity to see whether that fits into their funding. And maybe it will. They have funding and ability to pay those premiums each year, knowing that eventually $1 million or whatever the amount of the policy is will be coming. So they're looking at it as an investment in a long-term asset, I guess, for lack of a better way to put it.
Yeah. Those are good answers. Okay, and then one final question then. What special tax treatment exists for gifts of qualifying publicly traded securities?
So it's one of the best things to donate because it's easy to donate. It's easy to value. So from that perspective, it's not requiring an appraisal like a piece of real estate or something else would. So you can donate a share of capital stocks, so Google or Apple or TELUS, whatever it is you have, mutual funds, interest in segregated funds, or certain prescribed debt obligations, but things essentially that you're buying through your financial advisor with very few limitations.
Okay.
But the great advantage to donating securities or a similar vehicle is that your capital gains inclusion rate, despite the fact that you've had that disposition, your inclusion rate is 0 rather than the 50%.
Wow.
So you're having the benefit of not paying tax on that increase in value, but you still get a donation receipt for the full amount. So if we thought of an example, so if you had 100 shares of Google, for example, and you paid $75 per share for them, and they're worth $100 now, each share has got a capital gain potentially of $25.
Mm-hmm.
And so you have two ways to look at donating. Am I going to donate the shares directly, $10,000 worth of shares, or am I going to liquidate the shares and donate what I have left? So by donating the shares directly, your capital gain inclusion is 0. And so you don't pay tax on the capital gain. So you still have a full $10,000 that you can donate, and be net the same amount and get that donation receipt for the $10,000. If you instead wanted to donate cash, you would need to sell those investments, pay tax on the capital gain. And so if you were looking at the highest tax bracket in Alberta, the tax on the capital gain would be about $600. So you only have, in this example, $9,400 to donate to the charity. So the charity's getting less, you're getting a smaller donation receipt, and you're paying tax. So, looking at opportunities to work with your financial advisor to donate securities is a very, very useful way to plan that donations. You're able to give more, and your financial advisor can work with you on whether or not sort of offset that and donate those and then rebuy them in your portfolio, whatever's going to work if it's something you want to keep.
Yeah.
But I do warn clients, this is, again, not something that you should be mentioning to your financial advisor on December 15th. This should be something that's part of your overall, when you meet annually with your advisor to talk about your goals and objectives, let them know that, in this year, I would like to donate $25,000 for a number. Can you work with me to find good times in the year that we should look at doing that? And it can be just a really great partnership between you and your advisor, benefiting something that's really important to you. So it's a win-win for everyone when you're having those conversations with your advisor to let them help you get to where you want to be.
Yeah. How long has that policy been in place?
I'm not sure what year it came into place. It's been in place the entire time I've been practicing, but and it's a really great way to contemplate donating, and most major charities are going to be able to accept those donations of securities without an issue. If you're looking at donating to a smaller organization, you might want to check with them whether or not they have the capacity to be able to take securities.
Right.
Similarly, you don't necessarily want to set up a small local charity of now having to set up an investment account in order to be able to accept those.
Mm-hmm.
But a lot of us are donating to larger organizations in our community that are well set up to be able to do those and have great information on their websites of how that's easiest for them.
Right. Yeah, I think it's a great idea to donate publicly traded securities. So if the charity then sells them, does the charity incur any capital gain or any tax issues?
Well, they do have a capital gain, but as long as they're still retaining their status as a registered charity, there's not a tax impact of that.
Wow. Hey, so everybody benefits.
Mm-hmm.
So in your experience, have you found a lot of financial advisors are aware of this opportunity?
I think a lot are, but I don't know if it always comes up in conversation with overall planning. So I think when you take your various designations and things, it comes up as a topic and a great option for planning. But there's so many other things to discuss with clients that I'm not sure that all of us as advisors have mentioned that to people often enough. because there's and similarly, when we're talking to our clients, we're not usually talking about one thing. We're usually talking about 4 or 5.
Yeah.
And so it's worth revisiting that, particularly if you're looking at their tax return and you're part of your overall planning going, oh, well, look, they're doing a lot of donations. Do they know how they can maybe even make those even better?
Yeah, well, that just hits home to me that, if you're a high net worth individual, it's important to make sure that you've got not just a financial advisor, but an accountant, a lawyer, all the advisors to make sure that you get the best overall advice for your situation.
Absolutely. And, similarly, welcome those advisors to have meetings together with you as well. So that if you're having a meeting with everyone on the Zoom call or everyone in the room, we're all working in the same direction to get you where you want to be as well.
Yeah.
And also, we quite often talk the same language, and maybe our clients don't realize some of the bits of what we need. And so having that ability to have a meeting together, we definitely encourage, because then someone can stick up their hand and say, well, that doesn't fit in with the overall financial plan. I need to rejig it, or here's why it can't be. And we, from a tax perspective, can say, well, do we know that that's the tax impact? Are we okay with that? And so, or the lawyer can say, well, you already put that in a trust. You don't even own it anymore. So, sort of being able to have all of your advisors working together and be confident with that is a great way to proceed with your overall planning.
Yeah, absolutely, for sure. But you know what, Michelle, it looks like we're out of time. Thank you so much for being on our podcast today and for providing such great value and insight. So thank you very much.
You're welcome. I enjoyed it. It's great to be able to pass on some ideas and some opportunities, because similarly, when we're able to share information, it benefits everybody.
Yeah, for sure. How can our audience get in touch with you?
So I'm easily found on our MMP website. So it's mmp.ca, and you can search my name, Michelle Coleman, or you can find me on LinkedIn as well. I'm relatively easy to find. I use my middle initial, Michelle D. Coleman, because there's an Olympic swimmer with the same name, and when she's doing well, you can't find me, you find her. But I am quite easy to find.
Okay, so Michelle D. Coleman.
Yes.
Okay. Well, again, thank you for being on our podcast. And I want to thank our sponsor, Customplan Financial Advisors. Customplan Financial Advisors is an award-winning MGA that provides exceptional support and resources to the independent financial advisor. Please visit their website at customplanfinancial.com. This podcast is available on YouTube, Spotify, and at financialpodcast.ca. To be notified directly when new podcasts are available, please subscribe by visiting financialpodcast.ca. If you have an idea for a podcast or know of someone who would make a great guest, please send me an email at info@financialpodcast.ca. We'd also love to receive your feedback. Thank you again, Michelle. You were great, and it's much appreciated. And to everyone else, have a fabulous day.
The views expressed here are those of the participants and not those of Customplan Financial Advisors, Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.